Hey everyone, welcome back to Corporate Decoder. Today, Digital Brands Group Incorporated DBTG just filed a Form 8K relating to material definitive agreements, and I am seeing a massive red flag. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is raising a significant amount of money through debt and equity sale agreements, and it looks like they are in a very tough spot trying to fund basic operations. So what is happening here? Digital Brands Group, or DBTGI as you might know them, has entered into several agreements to get much needed cash. They have a securities purchase agreement, a convertible promissory note, an equity purchase agreement, and a registration rights agreement. Essentially, they are selling future stock and borrowing money under some pretty tough terms to keep the lights on. Let's break down the main deal. The company entered into a securities purchase agreement on the 23rd of July 2026. Through this, they are issuing an unsecured convertible promissory note for a principal amount of $3,529,412. Now, that looks like a big number, but here is the catch. It is based on a subscription amount of $3 million divided by 0.85. This means they are effectively getting much less cash up front than the face value of the note. Think of it like borrowing $3 million but agreeing to pay back $3.5 million later because you are getting money at a discount. This is a common sign of financial distress. Where is this money going? The company states the funds are for general working capital and to pay off some existing debts. This tells us they are not spending this money on new growth initiatives or expanding their business, but rather just to cover their immediate operational needs and clear outstanding bills. To facilitate all this, they hired Aegis Capital Corp. As their placement agent, Aegis gets paid a commission of 3% on the subscription amount, which is $3 million. That's $90,000 right off the top, plus another 3% on any future sales of what they call put shares. On top of that, DBTGI is also reimbursing Aegis for expenses like legal fees. So a good chunk of the money being raised is already earmarked for these fees and expenses before it even reaches the company's operational accounts. Now let's talk about the note itself. The principal amount is $3,529,412 and it matures on the 23rd of January 2027. That's less than a year away. There are scheduled repayments of $1 million on the 23rd of October 2026, the 23rd of November 26, and the 23rd of December 2026. With the remaining $529,412 due by the 23rd of January 2027. These are very aggressive repayment timelines, especially for a company likely struggling with cash flow. And here is a big kicker. If they miss any payment, the interest rate jumps to a whopping 20% per year. That is incredibly high and signals that the lender sees DBTG as a very risky borrower. Defaulting would also trigger a mandatory payment of 120% of the outstanding principal and interest. This is a serious debt burden. This note is also convertible into shares of DBTGI's common stock. If there is an event of default, the lender can convert the debt into shares at a price that is 90% of the lowest closing price over the preceding 5 trading days. This is a significant dilution risk for existing shareholders. If the stock price keeps falling, the lender can acquire a lot more shares for their debt, effectively watering down everyone else's ownership. This mechanism is designed to protect the lender in a downside scenario, and it heavily penalizes common shareholders. Then we have the Equity Purchase Agreement, or ELOC. This is an agreement that gives DBTGI the right to sell up to $100 million worth of its common stock to the purchaser over a period of 3 years, ending in July 2029. The purchase price for these shares will be 95% of the applicable lowest daily VAP, or lowest traded price during a specific valuation period. This is a classic at-the-market offering, but with a steep discount to market price, which is another sign of desperation. There are limits on how much stock the purchaser can own at any one time, capped at 4.99%, which can be increased to 9.99% with notice. This is to avoid triggering certain reporting requirements for the investor, but it doesn't change the fact that they are buying shares at a steep discount. For agreeing to this ALOC, DBTGI has already paid a commitment fee of 1% of the $100 million facility. That is $1 million likely paid in stock or warrants, further diluting shareholders. This fee is paid just for the option to sell stock later. Finally, there is the Registration Rights Agreement. This essentially means DBTGI has to file paperwork with the SEC to allow the purchaser to easily sell the shares they acquire through these agreements. They need to get a registration statement declared effective within 75 days of the closing date. If they fail to do so, they face liquidated damages, which means paying penalties. This shows the urgency and the contractual obligations tied to these fundraising efforts. Looking at the exhibits, we see the actual agreements are filed. Exhibit 10.1 is the Securities Purchase Agreement. Exhibit 10.2 is the Convertible Promissory Note. Exhibit 10.3 is the Equity Purchase Agreement, which is the ALOC we talked about. The filing is signed by John Hilburn Davis IV, the President and Chief Executive Officer. This confirms the senior leadership is aware of and signing off on these significant financial maneuvers. So, what is the bottom line here? DBTGI is engaged in multiple agreements that point to a company in serious need of cash. They are raising money through debt that carries a high interest rate and convertible notes that can lead to massive shareholder dilution. They are also setting up a mechanism to sell stock at a discount for potentially years to come. This is a classic pattern for companies struggling to generate consistent revenue and profit. Compare this to how other companies in similar situations have acted. For example, APL did a similar debt financing in 2022 that led to significant dilution and a subsequent decline in share price by over 70% in 6 months. What I am actually seeing here is a company fighting for survival, not growth. My biggest concern is the steep discount at which they are willing to sell their stock and the high interest debt, which puts immense pressure on existing shareholders and the company's long-term viability. The risk I am watching is how much further dilution can occur, and if the company can even meet its near-term debt obligations. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.